But right now it's time to welcome our first guest, Peter Schiff. Peter Schiff is an American stockbroker, financial commentator, radio personality, and author, among other achievements. He's a CEO and chief global strategist of Euro-Pacific Capital, Incorporated, and the host of the Peter Schiff podcast. He's a frequent guest on many of the top business and financial TV shows, and his books include Crash Proof, How to Profit from the Coming Economic Collapse. Peter, it's been a while, but welcome back to the show.
Oh, thanks for having me on again.
All right, now of course you're here, you do understand we're on Newsmax, right? And so we're pretty politically conservative here, and I know you're from Connecticut, and I know you went to University of California, Berkeley. So
Yes.
How does that all fit into being on Newsmax? Help us out here.
Well, just because I went to UC Berkeley doesn't mean I got indoctrinated with any of their propaganda. I was pretty much a free market, libertarian, Austrian economist when I went in, and I came out with my head on perfectly straight. Now I only make my summer home, though, in Connecticut. I reside full-time in Puerto Rico.
Ah.
Yeah.
Now, I'm sure that has absolutely nothing to do with income taxes. So with that in mind, what's that?
Yeah, well, I don't really pay any anymore, so.
Exactly, I understand completely.
It's good to be in Puerto Rico. Plus, it's nice and sunny.
And the weather's a little nicer in the wintertime. I get that. So briefly then, we just got past the midterm elections. Based upon the results, what do you see that changing, if anything? How could people react differently with their portfolios based upon that? Just give us your quick thoughts on that.
Well, I don't think it really changes much. I think the economy is a gigantic bubble. I think Trump was right as a candidate. The air is coming out, but since a lot of people don't recognize it's a bubble, they don't see what's happening. So I think we're headed to a recession. I think it's going to be worse than the '08 recession, the one we call the Great Recession. I think the difference is with a Democratic Congress, I think the stimulus that we're likely to get will include a lot more government spending, and the tax cuts that we get next time will probably be targeted to lower income and middle income earners. So they will be more inflationary than the ones that we had before. I think the impact on the deficit will be even greater. I think as much debt as Trump has added during the first 2 years of his administration, I think it's going to be much greater during the second half. I guess the only good news for Trump is instead of blaming the recession on the Federal Reserve, he can also try blaming it on the Democratic House of Representatives, because I think the next election is going to be not about who gets credit for the booming economy, but who gets blamed for the bust.
Okay, so you're making a time frame prediction then that the bust will occur within 2 years. But is this the bust created by the Federal Reserve and all the quantitative easing and all the printing of money? Is that your primary thought as to what caused the bubble? Because I agree, we're in a bubble.
The Fed is the principal culprit here. They've been blowing successive bubbles since Greenspan was around, and they blew up the dot-com bubble, and that popped, and then they blew up the housing bubble, and that popped, and now they have a bubble in everything. And this is the mother of all bubbles. And when it pops, there is no larger bubble that's going to take its place. So we're finally going to have to pay the piper for all these bubbles. And believe me, we've run up quite a tab.
So how much of a stock market drop do you think could occur when this next bubble bursts? If it's worse than 2008, heck, most people had a 50, 60% decrease in equity values during that time. Are you saying this could even be worse in people's portfolios potentially?
It could be. I mean, it certainly could be as much as 50%, if not greater. Certainly, there are a number of stocks out there that are going to fall a lot more than 50%, regardless of how much the averages go down. But a lot of it might depend on just how much inflation the Federal Reserve unleashes. Because, if they print enough money, they can stop stock prices from falling. But what they can't do is stop other prices from rising, like food, energy, and the basic necessities of life. And so I think to the extent that the Fed can conceal the decline in the stock market beneath a layer of inflation, stockholders are not going to feel wealthier. They're going to feel poorer. And I think if you want to measure stocks in terms of an ounce of gold, I think the decline in the real value of stocks is going to be much greater in this next decline than it was in the previous one.
Quite interesting. Well, you're preaching to the choir here. I can't argue with that. We need to take a commercial break. We come back, we want to talk to you more about why. And then I also want to talk to you about how you think that's going to affect interest rates when all of this unfolds. as you said, sometime most likely in the next 2 years. And you stay with us also. We'll be back with more here on The Income Generation. I'm Dave Scranton. We're here with Peter Schiff. But right now, it's time to welcome back Peter Schiff. So Peter, you know, how do you think interest rates are going to fare with all this? I know the Federal Reserve is desperately trying to raise rates so they have more bullets in their gun next time there's a recession to lower rates again. Are they going to get their gun loaded quickly enough, or do you think people are going to start shooting, the economy is going to start shooting at them before they do?
Well, that gun is probably going to backfire. I mean, first of all, the Fed is likely to keep nudging rates higher. They're oblivious to what's going on. They have no idea that we're facing an economic crisis worse than 2008. If you recall, they were completely blindsided by that crisis. But we are looking at a stock market decline, a housing decline. In fact, this housing bubble is bigger than the one that burst in 2007, 2008. In fact, it's already happening. Look at what's going on. The home building stocks haven't been this weak since 2007. The inventories of unsold homes are exploding. Prices are about to fall through the floor. The Fed doesn't understand how this is going to impact the economy, the reverse wealth effect, all the foreclosures, and the unemployment that will result from the collapse in the housing market. But the Fed will probably keep raising rates until they see the economy in recession, until they see the bear market in stocks and the collapse in real estate prices. And then they will do what they've always done. They will slash interest rates. They will launch QE4, and they will expect to bail out the economy like they did before, except they're going to be surprised because it's not going to work the next time. It's not going to be the third time's the charm. It's going to be 3 strikes and you're out. So what's going to happen with the next round of quantitative easing is the dollar is going to collapse, and the only prices that are going to go up are going to be consumer prices, the price of goods and services that Americans buy every day. And as the cost of living goes up, the American standard of living will come crashing down.
So in the minute or so we have left in this segment, 2 questions. Number one, how can the dollar collapse when a lot of the European currencies and so on really they're in as bad shape, if not worse shape than us? So let's start with that question first.
Well, first of all, I mean, the euro and the dollar aren't the only currency out there. There are plenty of currencies against which the dollar can lose value. But I would disagree that the U.S. dollar or the U.S. is in worse shape than Europe. I think, that Europe's in worse shape than the U.S. I think we're in worse shape than Europe. And I think people are going to find that out. I think investors are too concerned about what's happening in the Eurozone or Japan or China, and they're missing the even larger problems here in the United States. So I think the dollar is going to be weaker than the euro, but I think both currencies are going to lose value in terms of purchasing power. I think the price of gold will rise in dollars and euros.
So Peter, 10 seconds. Do you think we'll get to negative interest rates in this country this time around like happened in Europe last time?
Well, we already have negative real rates. I don't know that we'll ever get to negative nominal rates, but the Fed will certainly go to 0. But I think they're going to lose control of the long end. And I think long-term interest rates are going to go way up, despite the Fed's.
And I think they're losing control of that already, absolutely. We need to take a commercial break. Stay with us. We'll be right back here on The Income Generation. Now, let's welcome back, once again, Peter Schiff. So Peter, let's talk about how our viewers, how our Income Generation members can strategize in an environment like this. What types of things are you recommending for clients of your firm, per se, in this environment if it's coming up really within the next 2 years?
Yeah, well, I've been preparing for this for a long time. I mean, it's been a long time in the making. The Federal Reserve has been inflating this bubble for decades. And, we almost, had to pay the piper in 2008. But unfortunately for the United States, the Fed was able to blow an even bigger bubble and kick the can down the road. And now we're catching up to that can. And again, at this point, it's so big that if anyone tries to kick it, they're going to break their foot. So what investors need to do is be out of U.S. financial assets. That includes stocks and bonds. They're both going down, and real estate, although if you're talking about residential real estate, that might be harder to unload. But it's certainly easy to sell stocks and bonds. And investors need to get out of the dollar. And that's what we're doing with our clients at Euro Pacific Capital. We are constructing portfolios of foreign assets, undervalued foreign stocks that pay good dividends. We're also focusing on gold and silver. I think these are excellent inflation hedges. I think inflation is going to break out worldwide, not just in America. It'll be particularly pronounced in America, but other nations are going to experience it. And so you need to have gold and silver in your portfolio. The precious metal stocks, I think, are important parts now of a stock portfolio. I think there's a lot more upside in the mining companies than in the metal themselves. So we have all sorts of strategies. I think the emerging markets, some of the stocks there are particularly attractive right now. In fact, I think what's going to be unique about this next recession is it's going to be particularly severe in the United States, but I think the emerging markets are actually going to see their economy strengthen as the dollar collapses in the U.S. recession, because it's been the strong dollar that has been hurting the emerging markets, and they're going to get relief when the dollar falls, and that's going to be a big tailwind for their economy.
So, Peter, so I could see, strategizing to say, okay, let's invest in other currencies and try to play that. But I guess the gold thing, I've always said I've got an issue with the gold thing. Nobody's really pegged to gold anymore in terms of currency. So is gold really still an inflation hedge? I mean, the reality of it is if the stuff really hits the fan, people need food, they need clothing, they need shelter. Who's going to be there to buy gold in that environment? And gold isn't really used in that much technology.
If you want gold, if you want food or shelter and you have gold, you'll always be able to buy it. Not so sure about all these fiat currencies. Look, gold is still a monetary metal. It is held by all the world's central banks. In fact, central banks are accumulating more gold. I think they're preparing for a post-US dollar reserve currency world where I think gold will once again be the principal reserve asset, and I think currencies will be backed by gold again, the way they were prior to 1971 when they were backed by the dollar, but they were indirectly backed by the gold because the dollar was as good as gold because it was convertible into gold on demand of the holder of dollars. But gold has been around for thousands of years, preserving purchasing power. It has survived all sorts of fiat currencies that have come and gone,
and you think
it will survive.
It's going to survive. Peter, unfortunately, we need to leave it there for now. We're out of time. Time flies when you're having fun. Thanks again for being on the show. We really appreciate it.
Okay, bye-bye.
Stay with us. We'll be right back with more here on The Income Generation.